lot of classic equity managers start with a firm belief in certain characteristics that needs to be fulfilled before we go and invest. So they start with screeners. Well, we exclude all companies that doesn't grow faster than X and doesn't have a return on capital that is better than this and should be part of these sectors, etc. We start from, and that's back to my background at Saxo. We start with, okay, what is the world going to look like? What is the big vectors into the future where you can have pretty predictable demand drivers for that type of theme? So it could be cybersecurity. It could be European rearmament in the defense sector. All these different themes, we identify them. The next layer is then figure out what companies gives the best exposure to that long-term theme, and figure out among those companies who have the greatest superpowers. It's a different word for basically who has the best competitive advantage position in the industry. Then level 3 is probably where a lot of equity managers and analysts start. Then we do the valuation model. And the reason why we're not really interested before that in step 3 and not really that obsessed about the valuation and the PE ratio and all that is that, like, you never call a a real estate broker in Copenhagen and tell them, give me the 3 cheapest apartments you have in Denmark or in Copenhagen. Okay, but then you'll end up in these very not very nice looking areas. And so you have to start from the top, predictable demand drivers, where the future is going, find the highest quality in terms of competitive advantage, and then you do the valuation. After step 3, we have a 4th layer, which is called a checklist. So it's like a pilot before takeoff. You have certain criteria as honesty and credibility of the management team. The company needs to grow faster than the overall nominal economy. There's certain thresholds for return on invested capital. You have all these things on the checklist. We go through them. Most of our investments cannot tick all the boxes. And then the 5th one is, so what you get from modeling a company is that you can get to what is the expectation set that is priced into the company on the stock. So the 5th layer in the investment decision is, do we think this company long-term can actually beat those expectations that are built into the stock price? And if we can say yes to all these 5 layers, we go ahead with an investment.